Credit scores. Everyone knows they're important, but few people truly understand what goes into them. Today, I'll explain credit scores simply: what they are, what affects them, the biggest myths, and the habits you can start today. So, what exactly is a credit score? Think of it like a financial reputation. It's a 3-digit number, usually between 300 and 850, that lenders, landlords, and even some employers use to judge your trustworthiness. A higher score means you're seen as lower risk. That can unlock better interest rates, easier approvals, and even save you thousands of dollars over time. A lower score, on the other hand, makes borrowing harder and more expensive. Your score is based on 5 main ingredients. The first, and most important, is payment history. This makes up about 35% of your score. Every on-time payment helps build trust, while every missed payment can stay on your record for years. The second factor is credit utilization. This means how much of your available credit you're using. For example, if your card has a $5,000 limit and you owe $4,000, you're using 80%. That looks risky to lenders. The goal is to keep your balances low. Under 30% of your limit is good, and under 10% is excellent. Even if you plan to pay off your card in full, consider making an early payment so a lower balance is reported to the credit bureau. The third factor is the length of your credit history. Lenders want to see how long you've been managing credit. The older your accounts, the stronger your score will be. This is why it often makes sense to keep your oldest credit card open, even if you don't use it much. Closing it can shorten your average history and actually lower your score. The fourth factor is your credit mix. Do you only have credit cards? Or do you also have things like a car loan, a student loan, or even a mortgage? A mix shows you can handle different types of debt responsibly. That said, never take out a loan just for variety. Credit mix can help, but it isn't worth adding debt you don't need. Finally, the fifth factor is new credit inquiries. Each time you apply for a loan or card, the lender does a hard inquiry. A few of these aren't a big deal, but too many at once can temporarily lower your score. Now let's talk about the myths, because there are plenty of them. These myths confuse people and often cause more harm than good. Myth number 1, checking your credit score hurts it. That's false. When you check your own score, it's called a soft inquiry, and it has zero impact. Monitoring your score is smart and safe. Myth number 2, carrying a balance helps build credit. Also false. You don't need to stay in debt to prove you can use credit. Paying your card off in full is always better, and it saves you from paying interest. Myth number 3, you need debt to have a good score. Not true. You can build excellent credit simply by using a card wisely and paying it off every month. Long-term debt is not required. So, what habits actually improve your score? Let's keep it simple with 3. Habit number 1, always pay on time. Even one late payment can drag your score down, so set up auto-pay or reminders to stay consistent. Habit number 2, keep your balances low. Use your cards, but don't max them out. Paying in full every month is ideal, but even keeping balances under 30% will help. Habit number 3, be selective with new accounts. Every application is a small ding. Spread them out and only open accounts you truly need. Here's a quick example. Imagine Sarah and James. Sarah pays on time, keeps balances low, and opens new accounts carefully. Her score steadily rises. James, on the other hand, pays late a few times, maxes out his cards, and applies for 3 store cards in 1 month. His score drops fast, and it takes years to recover. The difference isn't luck, it's habits. Small, consistent choices make the biggest impact over time. At the end of the day, your credit score doesn't need to be scary. It's not about being perfect. It's about being consistent with smart behaviors. Pay on time, keep your balances low, be careful with new accounts. Do those 3 things, and your credit score will improve steadily. If you found this helpful, make sure to subscribe for more simple money tips explained clearly. Together, we'll make personal finance less stressful and a lot more empowering.